Alright, after a significant amount of technical difficulty as usual, finally we're able to get started here. I'll wait for a couple people to start hanging out, see how this is going. So I decided I was going to use the Wacom Intuos pen, which gave me a really hard time. You can see I got this tablet here so I could actually draw instead of trying to use a mouse to draw on this thing. But let's see if this works out. So I could finally kind of write things with this. It just took me about 15 minutes to realize how to get these little circles to stop drawing, which was really, really annoying. But we are locked and loaded. So, alright. Got a couple people in here now. I'll wait another minute. How's everybody doing today? Who's got Bitcoin? I know somebody in here bought Bitcoin at like 10 G's. Yeah, I know King Hargrave wants more videos. I know, that's why I'm doing this now, because it's the closest I'm going to be able to do to actually making a video today. But I'm going to try to kick one out before Christmas, or before Saturday, really. I'm going to try to make one on the leaps this week, which is the last thing we need to do before we do the poor man's covered call, which I know everybody's waiting for. I have Bitcoin at 23,000, yep. Specialist perspective, got a Bitcoin, sold a bunch today. Sold a bunch of Bitcoin? Okay. Alright, I dig it. Yeah, I got Riot too, but why is Riot? Let's take a second before we get started and let's take a look at Riot real quick. Why is Riot not absolutely mooning right now? Is my question. I bought 100 Riot yesterday. And so far, I mean, it's alright. It's up. It's up 5%. I guess I can't complain too much. But I'm a little bit disappointed by the lack of muscle I'm seeing here. It's not following Bitcoin. So we got Bitcoin on Robinhood. Let me just see what's going on here. Bitcoin at 23.5. God, that's crazy. You guys want to know something fun? I bought Bitcoin. What's going on here? I'm not getting the full screen that I need. You guys want to know something fun? I bought Bitcoin right here, and then I sold Bitcoin right here. And I've been mad about it ever since. In fact, let me look at Litecoin real quick. This is only going to go back 5 years. Actually, this isn't even going to get us there. But I was getting ready to buy an ASIC miner, a $10,000 ASIC miner in 2013. I almost did. I was at the checkout screen. And then I realized electricity would cost too much. Man, if I had been mining Litecoins this whole time, man, I don't know, I'd be a millionaire right now. But then again, I probably would have never bothered to make a YouTube channel. So, yeah. Good and bad together, right? Alright. Hey, I guess it's time to get going here. So, one of these Centurions requested a live stream on how to choose stocks in a market where everything is just exploding. Right? Then once you choose the stock, how do you actually go ahead and choose the strategy that you want to use for it? Now, everything over the past several months, you don't need to really do anything except buy calls, right? So if we're just buying calls, we're going to make a lot of money these days, but eventually this whole printer era is going to dry up. And we need to be able to do a little bit more than just throw money at call options. In fact, most of us here probably haven't been doing that since the beginning, since we've been timid about just throwing money into FDs. There's a market for that. It's not Theta Gang. So we've all been doing pretty well lately. But how do we actually go ahead? We want to choose some stocks that we like to wheel, that we want to sell strangles on, that we want to do the poor man's covered call on. What do we do? All right, so there's a handful of things that we can look for. All right, first of all, people tend to get the wrong idea when you're choosing stocks. The truth is you don't need to be good at trading everything. Okay, nobody gets to just look at a stock and then all of a sudden know exactly what to do. All right, that's not something that we get to enjoy in real life. So what my first recommendation is what's going on with my tablet here? I thought I had this problem solved. Spent a lot of time. Shit. Sorry guys, I'm a boomer. Screwed this up again. Alright. Let me reset my screen. Motherfucker. Anyway, as I was saying, Yeah, when you get involved in finance, right, everybody seems to get this idea that you need to be able to trade everything all the time. Doesn't matter what stock you're looking at, you need to know what strategy to use, and then just go ahead and throw money on it. The truth is, you aren't going to be an effective trader if you don't have a watch list. Why is this so large on my screen? All right, the first and most important thing about being good at picking stocks, that's why, because I zoomed in, is that you need to pick your watch list and identify things that you're actually going to be decent at trading. My watch list, for example, I don't trade everything. I trade tech, I trade finance stocks, like other banks sometimes, and dividend aristocrats. Outside of these, I don't really have an industry that I can follow and actually be successful trading in it. And the fact of the matter is, when you're picking your stocks, the first thing you want to do is pick a sector so that you can actually learn about it. You could probably get away with just trading one stock over and over and over again throughout your entire trading career. All right, if you just know what Apple does, how to trade Apple, that's all you actually need to do. So my very first recommendation is pick a watch list with some sectors that you actually have some background knowledge in. I'm not a... Why does this only update? I notice that the comments only update if it's actively open, so I gotta move this down here so your comments will keep updating for me. Alright, very first step though, pick something that you can actually be good at and know about it. Alright, once you're into a sector, that's when it starts becoming fun. Alright, now you can actually go ahead and start picking stocks that you know something about and that you actually think are going to do well in the future. So a handful of things that I'm going to look for when I'm picking a stock within the sector that I know about. Alright, the very first thing I'm going to look for in a stock is liquidity. Now, liquidity is as simple, for those that don't know, you should know this by now, in the case that you don't. Liquidity is the ability to actually trade when you want to. You can buy, and there's always going to be a seller. You can sell, and there's always going to be a buyer. Now, technically, every stock is going to be fully liquid because there are market makers. Their job is to buy when somebody is selling and sell when someone's buying. But those market makers that just do that, they're not giving you a good price. So if you see a stock where the bid and ask are like 3%, even 1% apart, that is a huge spread. And it's showing you that there's not a lot of buyers and not a lot of sellers that are actually negotiating and constantly having a meeting on a price. So you wind up with wide bid-ask spreads, and that's a bad sign. The things that we look to avoid when it comes to liquidity, we want to avoid low volume. We want to avoid wide bid-ask spread. And we want to avoid options markets where there is low... Uh-oh. God dang it. I just lost my second monitor. Guys, I'm about to give up on this. I've made a mess out of this. God dang it. I think I'm about to break the record for the most buggy live stream ever in the history of the market. God damn it. My power cable came unplugged. Yeah. Anyway, what a mess on this thing I've done. My power cable came unplugged. But, hey, we're back in the game. So, let's try this again. And the PMCC video is coming probably the week after next. I'm aiming for it. Alright, let's get back to it. So we're looking to avoid low open interest on options. Low open interest would indicate that there are not a lot of buyers and sellers that have actually made arrangements. Nobody has actually bought calls. Nobody has actually bought puts. We're just kind of sitting in a situation where market makers are prepared to do that if somebody wants to buy, but nobody's actually trading options. And if we look at an example of what a low open interest stock looks like, we could be looking at, I don't know, what's something that nobody's really trading options on? I should have had one prepared. Let me think. Let's type in like some random letters. Actually, let's go with, I bet you the Santander Group. Let's spread this out a little bit here. I bet you the Santander Group has low open interest, just because I've never heard of it before. I just randomly grabbed one. So if we're trading a stock where the open interest on it, let's see, volume 1. Open interest, all right, 2,400. It's not pitiful, but this volume of 1 would indicate that there is not a wide market available to actually trade this stock or this option when we want to. All right, probably not the best example of low open interest, but occasionally if you're looking at a stock with super low options trading, people just aren't interested in it, you wind up with low open interest. And that means you can't buy and sell when you want to. And that's going to cause a lot of heartache and a lot of problems, especially when you're looking at potential profit that you can't actually seize because nobody is available to buy your options. All right, unusual circumstance to be in, but it does happen. And we want to make sure that we're choosing stocks that do not have a low open interest. We do not want wide bid, and we want significant enough volume that we can actually make things happen when we want them to. All right, so once we've chosen our watch list, we're looking at some companies that we think are going to do well. For example, I think Apple is going to just continue dominating pretty much everything in the whole iPhone space. The tablets, all that, they're going to continue dominating it. And their services sector is only going to get bigger. There's obviously adequate liquidity on it. Okay? So that keeps it as a candidate. But what else, outside of a few things that we've already identified? All right, next thing that we're going to look for when we're choosing our stock is revenue. We want revenue increasing year over year, pretty much all the time. They need to have a rock solid reason if their revenue is not increasing. But why do we look at revenue instead of at earnings? Right? The reason that I don't look at earnings per share as much, I still look at it, but I don't look at it as much because revenue is where you're going to identify the growth of the core business. If revenue is increasing year over year all the time, that's a really good indication that they're going to continue growing in their space, carve out their market share. So market share, that's where you're going to see demand for products, whatever they're making, whether it's a good or a service. All right, let's say Palantir, we start seeing increasing revenue year over year. That indicates that there is demand for Palantir's products and services. All right, earnings per share, a lot more goes into earnings per share than into revenue. Well, now you're talking about the effects of tax. What happened here? This pen, guys, I swear. I can't even control Z on that. Yeah, I'm about to quit for real, for real. All right. I had to use my mouse. All right, you'd be looking at the effects of tax. All right. You'd be looking at the effects of accounts, like all weird. What else? Costs of business. Now you want to look at their liabilities, of course. This was actually easier with the pen. All right, you want to look at liabilities, but you start seeing all of these things affecting earnings per share, whereas they don't affect revenue. So if we're looking at core growth within a company's business model, I'm not as concerned about the effects of taxation or their costs of doing business. That's all secondary. I want first and foremost an increasing revenue. If you find these two things together and you're in an industry that you understand, the only thing that I additionally look for is dividend. All right. I don't care if the company pays a dividend. What I want to avoid is a company that slashes dividend. All right. If the company has never paid a dividend, that's okay. I know there's a lot of companies out there, great ones like Amazon, that have never paid a dividend their entire time in existence. But since they've never had one, that means that they're continuing to reinvest in the company, and the company now does very well. They continue to expand on whatever their business model actually is. And we all know about Amazon. A company that tries to push out dividends and then continually slashes them, that's an indication that they don't have the money to be able to sustain what they're actually giving in dividends. And NLY is a good example of that. I have positions in them. I'm skeptical about them because we continually see that dividend getting slashed. This is something that you see all the time in those high-paying dividend companies where they're paying out 10% and then they got to cut it in half because they can't sustain it. That's an indication that they're not capturing enough revenue to be able to sustain their dividend. All right. Sometimes a company will slash this dividend because they're saying, we're going to start paying off our debts with the money that we're saving. That can be okay. It's up to you to decide, are they making enough revenue? Are we seeing revenue increasing year over year that would justify them making the decision to slash their dividend and pay down debt instead, which could actually be better for the company than the dividend, better for the investor than having a dividend. All right. I'm wondering why this isn't holding in here. I really want this this screen to stay open. Maybe that'll work. Okay. The comments are coming in pretty quick, so I really haven't been able to see what you guys are actually saying. But I promise I'm trying to read them as they come through. It's just difficult for me to read and type at the same time because I'm not that smart. All right, let's try something else here. So I'm going to ban somebody that keeps talking trash real quick. Keeps using foul language. So I'm going to hide user on this channel. Bow, he's gone. Okay. So what are some of the actual the stocks that I'm actually trading? All right, we've talked about the things that I look for. What are my favorites right now, just for you guys' awareness? All right, my number one favorite stock that's probably never going to change is, somebody give me a wild guess before I type it out. Wild guess. Let's see. Oof, no, that's not it. Good guess, though. All right. I think there's too much delay for this to work. All right, my favorite one ever in life is Apple. There we go. We got a couple people saying Apple. Good choices. All right, Apple is going to be my favorite because I love their increasing revenue. There we go. All right, I love the increase in revenue. Revenue. Still learning how to use this thing here. All right, I love their market share. Not tremendous on their products, but I'm all about the way Apple has functioned as a company. So I've got 400 shares and 4 leaps. All right, other ones that I love Lam Research. This is probably up there. Not quite going to hit Apple, but I do love this stock. All right, massively increasing. They have huge market share. Something I didn't talk about but needs to be discussed is the moat. All right, moat is the amount of space the company has against its competition. So a company with a wide moat means it would be very difficult for competitors to get into that space and start competing with the company. All right, so I've got 100 shares. I've got a short put to buy more, and I've got 1 leaps. For those that don't know, leaps are very long-term call options with a very high delta. All right, and that allows you as the buyer of the leaps to own for a long period of time. You get a high exposure. It's just a cheaper way to own shares, basically. All right, and all of these leaps are pretty close to the money. They were at the money at the time where I purchased them, and now they're in the money. All right, and then another one I love is Prudential. I love this one for its dividend. All right, this company is going to continue increasing its dividend for a very, very long amount of time. It wants to become a dividend aristocrat, which is a very prestigious situation to be in. That means that the company has continued to pay a dividend every quarter for the last 25 years. It's increased its dividend, I think, every year for the last 10 or something like that. Very high standards for what can be considered a dividend aristocrat. Prudential is going to be there as long as it continues on the track that it's going on. I think that's its goal, is to reach that point. All right, so I'm in Prudential. I've got 100 shares and a short put, and then short put, so I can buy more. And then the ETFs, my favorites, QQQ, not going to change. I love tech industry. I think it's going to continue dominating basically everything. So that's why I stick with QQQ. And SMH is the other one. Shaking my head. Probably my next favorite dividend. All right, and this is semiconductors. All right, those are probably my favorite ones. Definitely not the only ones I'm holding. I got a whole bunch of other stuff too, but these are the ones that I'm really excited about. All right, so just as an example, this is what I look for. I'm looking for companies that are increasing their revenue, that have not slashed their dividend, that have high liquidity, and there's so many others that would fall into that category. All right, Microsoft definitely would be a contender on that. Tesla, probably another one. Right now I've got a short put on Tesla. It's printing right now, absolutely printing. Just sell out of the money puts on Tesla on margin if you have to. Definitely getting in there. So many different companies could fall into this. These are just the ones that I like. But now, the real question that the Centurion asked when they were asking for a live stream wasn't, how do I pick stocks? It was, once I've picked my stocks. Now, how do I pick the... I see somebody talking trash in there. Once I pick my stocks, how do I now pick the option strategy that I want to use in order to actually make money off of these things? All right, that is the million-dollar question. All right, there's one key metric that's going to make all the difference. All right, and this is also where things become less fun too. This is where stocks become not a game of, it's no longer fun to trade. Now we have to start turning it into a numbers game. All right, there's one metric that we look for. That is, I'm writing in black. That fun metric is volatility. Volatility. And this is probably my best and worst, my favorite and least favorite thing about trading is the swings in volatility. All right. This is also obviously known as IV. All right, we're going to look at our IV on a stock that we like. We want to trade. We want to participate. All right. Hey, the guy that's asking for statements and stuff like that, I will do that at the end of this video. All right, you're spamming chat. Let me get through this video, and then we'll do a portfolio reveal at the end. Would you guys like a portfolio reveal? We'll do that together. But stop spamming chat, or I'm just going to turn you off. All right. All right, this is implied volatility. People are going to simp for documents. All right, and then we also have implied volatility range. So IVR. All right, this is IV range. All right, so here's what we do. When we're looking at a stock that we like, all right, let's say, all right, let's use Apple as an example. This is probably one of my favorite stocks in life. All right. I like Apple. I want to trade Apple. I'm familiar with the company. I own their products. All right, I'm participating in Apple. I'm an Apple trader. But now what do I do? Do I just hold shares and that be the end of it? Or am I going to do something else? Well, we need to go strategy by strategy and kind of figure out when is it time to employ these. All right, my favorite strategy is probably always going to be the covered call, just because it's super simple to use, and honestly, it's still one of the best ways to make money off of your current holdings. In my whole experience, covered calls are usually the way to go. All right, so let's say, how do we know when it's time to sell a covered call? Like I said, the very first thing I'm going to look at is the volatility on this thing. All right, in periods of high IV, all right, when you have high implied volatility, the premiums on options, they increase. And this makes sense. If you think a stock is going to increase in value rapidly, you know, it's all up and down, the stock is trading very quickly, there's a lot of moves to be made, options buyers are going to be more interested in getting some skin in the game. And they're going to be willing to pay some additional money for it. So when you have a period of high IV, all right, this allows you to sell further out of the money options. So you can go further out of the money and still get an appreciable amount of money from that covered call sale. So if we're getting into a period of high implied volatility, which could come from all sorts of reasons, maybe a new product is about to drop, maybe earnings is coming up, this gives you the option to sell deep out of the money calls and still pull a significant amount of premium that you can then reinvest into the shares. So when I'm trading Apple, I'm looking for a high IV environment primarily. There's never any issues with liquidity. We have adequate liquidity. We're trading Apple, we have adequate liquidity all the time. Okay, so if we've got an earnings coming up, this is a good opportunity usually to sell covered calls. Earnings. All right, that's the most common. You're going to see that all the time. Earnings is going to send implied volatility much higher. And on the weeklies, sometimes you're talking about, I didn't explain IV range. But I'm talking about high implied volatility. That could be very different for different stocks. Some stocks like AT&T, you're going to have high implied volatility at like 10%. That's a very high, I'm just using that as an example. Low IV stocks typically, like AT&T, they're not going to have big swings. So a high IV environment for AT&T is not going to be the same environment that we would have for a very widely swinging stock like Tesla. 2 weeks ago, Tesla's implied volatility was still very high compared to the rest of the market. But for Tesla, that was a very low IV environment historically over the past couple of months. Now it's increased again. But 2 weeks ago, when Tesla was at the lower end of its implied volatility range for that stock, that was not the best time to sell covered calls because premiums had decreased. So you need to sell closer to the money and take more risk of getting assigned, which now we look for probability of profit. I hope I'm writing on screen because I'm starting to lose. All right, this is also POP. When you're trading a covered call on a stock with low volatility for its own historic implied volatility range, you have to sell closer to the money, closer to the market price, in order to get an appreciable amount of cash from that trade. And if you are in a high implied volatility environment for that stock's implied volatility range historically, then you can sell further out of the money. And when you're selling farther from the money, that reduces the probability that you're going to get assigned because the stock would have to swing a much greater distance in order for you to get assigned. So if you're selling close to the money, you have a lower probability of profit because you're likely to get busted versus if you're trading at the high end of the volatility range and selling a covered call out of the money. I'm writing beneath the screen. Sorry, guys. No, I think y'all got it. I can see it on my screen over here. I think you guys are good. All right, if I'm not, somebody else corroborate that. All right. What I was saying was in order to get a high, you want to trade your covered calls with a high probability of profit. And to do that, sometimes you've got to wait for the high until the stock is at the higher end of its implied volatility range historically. Right now, Tesla has gone up. That's actually last week. The stock, all right, it's cut off. Brawl Street, hey, thanks, man. It was cut off. Hold on. One sec. Trying to figure out where you guys lost it. I'm just writing below the screen. Okay, all that says below the screen where it got cut off is probability of profit. That's all it says. Okay. A high probability of profit means that you're unlikely to get your covered call assigned. You're selling deep out of the money. You'll have an opportunity to roll. Those are all things that will influence your probability of profit. All right. If you're trading on the lower end of IV, in order to get a decent amount of premium, you've got to sell closer to the market price. And when you're doing that, increase in volatility would cause you to get busted on that stock. All right. You're more likely to wind up in the money, and then you're in a bad situation. You have to either roll out or you're going to lose your shares. Okay. So we're looking for, when we're choosing our covered calls, a high implied volatility environment for that particular stock's implied volatility range is going to be the first metric that we're looking at. All right, and then this gives you another opportunity here too. Let me clean up what I got going on. We could also sell covered calls during binary events. And in fact, binary events there are a large number of strategies that are appropriate for trading on a binary event. Now, what is a binary event? This is when there is an event coming up that's likely to either make the stock go way up or make it go way down. All right, so this will give you, you're talking about earnings is the most obvious. My pen is messing up again. I'm about to buy puts on Wacom. Somebody let me know if this has a stock, if this trades. I'm about to buy puts on Wacom because I don't like their pen product. When it comes to a binary event, we're looking at earnings. All right, this could also be an FDA situation. Food and Drug Administration. This is especially important for pharma. So after years of doing research into a particular pharmaceutical product, the FDA comes to a company and says, you cannot sell this product, it is not safe enough, this is not adequate. That stock is going to go down. Or if you get FDA approval, the FDA likes it, they say this is safe, this is effective, then the stock will probably go up. So FDA play is considered a binary event. All right, other ones might be something like if there's regulations changing outside of FDA, so like regulation. So if we see something like Google, Alphabet, that could, big tech starts getting blown out by new regulations that force them to do all kinds of different things. Alphabet, you have to spin off your Google Chrome browser. That could force the stock to go down versus favorable regulations can make the stock go up. All right, so these binary events. When we have something like this coming up, we're going to have high implied volatility, which makes a whole bunch of opportunities to sell premium come into play. Some things that we wouldn't normally do in a low implied volatility environment. All right, so if we have a high IV, I've already mentioned that covered calls are good here. All right, we have high IV, we can sell out of the money. If IV goes back down, then all of a sudden our covered call is effective. We've made money off just by selling the call. Other ones that are going to work here. Let's talk about strangles and straddles. All right, we'll talk about strangle first. What I need is a third monitor, I just realized. That way I can get my comments over on one screen and get my OBS on the other. That's what I need. I'm going to need a third monitor. All right. Let's talk about strangles and straddles. So what is a strangle? Okay. All right, let's say the stock is trading. Here's the stock as a number line. Remember these? All right, and here's the market price. All right, of $100. With a strangle, we're going to sell a call over here at the 110, and then we're going to sell a call or sell a put down here at 90. All right, and we're going to collect, I don't know. Let's say it's a high implied volatility environment. Let's say we're going to get $1,000 total. Nah, that's too much. That's the collateral. That doesn't make any sense. Let's say we're going to get $600. Okay. So here's what we do. You're selling a strangle. You're selling a call over here, and you're selling a put over here. So you're selling out of the money in both directions. In a high implied volatility environment, all these deep out of the money positions, they're going to have gone up in value. Those options are going to be trading expensively because there's a binary event coming up. Volatility is high. People are willing to spend money to buy from you these out-of-the-money calls and puts. Once this binary event goes away, implied volatility is going to drop like a rock because there's no longer any impetus for the stock to make a huge move. It's going to move a little bit, all right? But let's say that there's an earnings report that comes out. The company is expected to make $5 per share, and it makes $4.99 per share. All right, it's going to drop some because people are excited about the company and it didn't make as much money as they wanted. So maybe it's now it's over here. Now it's 97. So now you've got a stock that's trading for $97. There's no binary event coming up. You have an out of the money put at 90 and an out of the money put at 110. Right? You made $600 for it. What do you think is going to happen to the prices on these out of the money options as soon as that binary event passes and there's no big change in the stock price? Implied volatility drops heavily. All right, and these short call and put, those get smashed. We know this as IV crush. Oh, you think my screen color and font color makes it hard? All right, what if I increase, what if I make the pen larger? Does that help? Would this help? No, that's going to be a little easier for you guys to read. It might be a little overkill, but let me know if that helps. All right, let's continue. We know as IV crush, let me clean up some space for me real quick. What I'm talking about here, all right, let's get rid of our binary event list. If we're anticipating we're in a high IV environment, a binary event passes, and now we're in a lower IV environment, now all of a sudden we have experienced let's do IV crush. Okay, that makes it easier to read. Okay, we're good. All right, now that we have sold this strangle and the binary event passed, there was no big change in stock price, the implied volatility on this stock is going to drop heavily, down to the lower end of its historical range. All right, I'm glad you guys enjoy the better font. Okay. So these out-of-the-money options, they're no longer going to be priced as richly as they were when you sold them. So when these go down, all right, we have already wound up in a situation where we are profitable because now we have out-of-the-money options in a low IV environment. The price is going to be significantly lower, and we will come away, we will benefit from IV crush, and we'll probably close pretty much right away. Close for a profit. If you're up 50% in a day, close your position. There's no reason why you should wait longer and watch this stock slowly drift down toward your 90 and you get busted. Just take your money and go right to the next play. All right. There was somewhere I was going to go with that. So when you're playing IV Crush, all right, you hit strangles are great for that. There's also another way to achieve this, and it's a little bit more risky. All right, but what if this is a little bit far away? We think that the stock is going to barely move after this binary event. All right, what can we do that could bring us even more than just the $600 premium? Sometimes you just want to go for it, and sometimes we are confident that a stock is not going to move. Maybe we've got some kind of insider info, whatever. All right, let's do, give me my brush. All right, let's say the stock, it's trading for 100. All right, and instead of going deep out of the money with these $10 in either direction for $600 premium, what if we go ahead and sell a straddle instead, where we're going to sell our call at $100. So we got a short call at $100. We're in a high IV environment. We're selling this thing for like, I don't know, $900. All right, and then we've got a short put. We're going to sell the put right there too. Let's just do another $900. Now we are collecting $1,800 in premium, and we will be able to realize this whole thing if the stock lands at exactly $100 after this binary event. But earnings comes out, stock was expected to make $5 a share, makes exactly $5 a share. It's expected to have $1 billion in sales. It had exactly $1 billion in sales. That earnings event, that binary event, no change is going to take place in the stock's price. Or it's going to change a little bit, but we're not going to wind up with these massive situations. And when I say sell a straddle, what I'm talking about is a short straddle. All right, we're going to establish a short straddle, and you do that by selling the call and the put. All right, the stock is barely going to move after this binary event. We were in such a high IV environment that these positions were trading very, very richly. We sold a call and a put for a high price. As soon as that binary event passes, it's going way down. We're dropping into a low IV environment because the impetus is past. There's no longer an earnings report that's going to make this thing move. All right, so what happens? These $900 positions, these are going to get IV crushed all the way to, like, I don't know, let's just say 250 each. So now the whole position is worth 500 bucks. You can walk away with $1,300 in gains very, very quickly because of IV Crush destroying these positions, destroying these options. And as a seller, you want them to get destroyed. All right, so we've talked about how volatility is the most important, probably the most important factor when it comes to actually choosing what strategy to use and when to use it. Basically, you want to sell into high IV environments. You don't want to sell covered positions, or naked positions for that matter, in low IV environments. So when you're in a low IV environment, what can you do to make money other than just holding shares? Okay, what I like to do, right, if we're in a low IV environment, let me clean up my screen. All right, let me get rid of my $ here as well. And Wacom, you guys bought your puts on Wacom? All right. I don't think this stream is going to last much longer because I got to get rolling here. But give me a couple minutes. Now we're done. Okay. Let's say we're in a low IV environment. All right, what do we do? Okay. So let's say, hey, it's just steady as she goes. Apple is doing its thing. There's no real impetus coming up. There's no new products. There's no earnings. We're just chilling. All right. How can we start making some money off of this? All right. A couple of things that you can do, and I'm not necessarily recommending this. I want you guys to just be aware that this is an opportunity for you if you're really interested in trading during a low IV environment using some Theta Gang strategies. Okay. So what we can use here, you have an opportunity. You have vertical spreads. All right, this is call credit spread, put credit spread, but instead of credit spreads, we're going to use debit spreads specifically. All right, we can also use leaps. Now, I'm making a leaps video very soon, so we won't go into too much detail on it. I'll just give you an answer. Leaps these are long calls. I guess they can refer to long puts too, but you're buying a call at a very you're talking like at least 270 days out. You can do, I sometimes will do 3 years. We're going to buy a call 3 years to expiration. All right, you can buy a leaps in a low IV environment because you're getting a lot of exposure to a stock for a lower price than it costs you to buy shares. And you also get to hold it for a very long time. And if IV expands, implied volatility starts increasing, the value of your leaps, your call option, is also going to increase. Even if the stock itself barely moves, if implied volatility increases, then you'll get more value out of your leaps. Hold on a second, guys. Pause 1 second. And I'll wrap it up in like 2 minutes. I know. 10 more minutes, not good. It's picture day, so we're tight on time, but I want to get through some here first. All right, when can we use, all right, so I've explained leaps. If anybody's got any questions about leaps, drop them in there, but I'm making a video on it like pretty darn soon. I'm going to try to make it before Saturday, but may not quite get there, but this is the next one. All right, and then we also have the opportunity, low IV environment. We're going to buy our leaps. We're going to wait until IV goes up, and then we're going to sell the poor man's covered call. All right, that's the next video right after the leaps. I promise. I promise. All right, so low IV environment. Let's get rid of leaps. You guys understand that one, and I'm making a video on it very soon. So let me get some room back. Okay. If you are in an environment with low implied volatility, we've already discussed we're going to have a little bit lower of a price on our options. With low IV, all right, you can take advantage of buying options for a lower price than it would normally be. So we are looking for an opportunity here to buy a debit spread. All right, you guys remember the call debit spread? I hardly ever use these because I usually trade in high IV environments. But let's talk about this one. Hold on. You can set the background color to black by setting the secondary color. Oh, no shit. I didn't know I could do that. Really? All right, I'm going to try that. Wow, that's absolutely game-changing. All right, whoever just dropped that in there, thank you so much. D's nuts, you're the best. I appreciate you. I'm a boomer when it comes to technology. Okay. Yeah, this is paint. All right, thank you for saving the day there. Puts on D's nuts. Or, I'm sorry, calls on D's nuts. Sell puts and buy calls on D's nuts. All right, a vertical spread. So what we're going to do here when we're buying a call debit spread, okay, we're going to buy a call out of the money, and we're going to sell a call deeper OTM, deep out of the money, okay? So if we've got a stock here, it's trading for 100. All right, we're going to buy the call at like 110. Whoops. We're not going to buy it for 100. We're going to buy the call for like, I don't know, let's say 105. All right, and we're going to sell another call for about 110. You could just buy the call in a high IV environment, honestly. You could just do that. It's option 2. We've also we've identified that there is adequate liquidity on these options. People are still interested in buying them. They're still trading. It's just a low IV environment. So there's not a lot of people that are dying to get their hands on a $105 call when the stock is trading for $100 in low IV. Okay? So what we're going to do is probably pay about, I don't know, let's just say $100 maybe. Probably it's not even going to be that high, but I'll just do it to make it easy. $100 for this 105. All right, then we're going to sell the 110 for like 30 bucks. All right, so this is going to end up costing us $70. 70 bucks to get into this spread. All right, when implied volatility expands, right, it increases, even if the price really doesn't, the value of both of these is going to increase. All right, so we're going to see value increase on the one that we bought and on the one that we sold. But the one that we sold is going to increase more. So we're going to get more value from this. And if the stock does increase, we're talking like maybe up to 102. Now the stock has moved. Now it's $102. This $105 call that we bought is going to increase in value faster than the 110. They're both going to go up, but we're going to get more delta out of our $105 call. So we're making money there. And we're still losing some off of this one, but we're going to lose less than we made over here. We're going to wind up in a positive situation where we've made money very quickly just from IV expanding and the stock going up just a little bit. Notice that we don't actually need our call to get hit, just like buying a long call. Okay? Now the question might come up, why don't we just buy the call? If it's a low IV environment, we're going to benefit from implied volatility increasing, we're going to benefit from the stock going up, why don't we just buy the call? And the reason I say go with the debit spread, cap your gain, but go with the debit spread, is because if we just bought this thing for $100 and we never sold over here, that's only 70 bucks. Or I'm sorry, it's costing you $100 instead of 70. So over here, we have spent 70% of the money that we would have spent if we just bought the call. And we're still going to make it pretty darn close to the same amount of money. Because this $110 is still really far out of the money. It's not going to get hit. The value of this is not increasing that much because the stock went from 100 to 102. So instead, we're spending 70 bucks instead of 100. Now we've got an extra 30 bucks that we can use elsewhere. Or maybe we just buy a share with it because we just saved ourselves some money. So when the stock goes up, you make money quickly. So we can use debit spreads in low IV. And of course, I don't have a lot of time to go into this, but you could use credit spreads in high IV. All right. I do have to get going, but I promised you guys a portfolio reveal. So I'm going to do that very, very quickly. But I'm going to ask for a minute of privacy because I don't want to completely dox myself here. So let me get that set up real quick, and then we will do a portfolio reveal. We've got YouTube on the side over there. All right, I'll show you guys my real account. Less than 5 minutes. Less than 5 minutes. I'll just log in here real quick. I'm going to turn my comments back on so I can see what you guys are talking about. Hey, Jacob, thank you very, very much for the super chat. If anybody else sent super chats prior, sorry, I didn't even notice it because comments were off for a little while on my screen. But he asks, how bad of an idea would it be to buy a Leaps put on Airbnb if IV is relatively high, been considering it? Like, it doesn't make it a bad opportunity to buy a Leaps. Like, there's never a bad opportunity to get into Leaps. Okay, so it is totally fair for you to go ahead, buy the Leaps if you're expecting a stock is going to drop. All right? If you think Airbnb is overpriced, go ahead, buy the Leaps, man. It doesn't matter. You're okay. Now, because Airbnb, the volatility is going to stay pretty high. So, all right, I'll show you guys first. This is my IRA. I hope I'm not like going to blow up my, let me see. Window capture 2. Let me flip over. I'll get Merrill Edge going. Okay, this is my IRA account. We'll do that one first because it's smaller. All right, I think I'm not doxing myself. Can you guys see everything adequately? Okay, here's the IRA. So we'll talk one at a time real quick. I don't have a whole lot of time. All right, so most of my IRA right here is in shares of Realty Income, which is an REIT that gives you money for just owning it. You get money every month. You don't have to do anything. They're the monthly dividend company. In fact, I mean, their stock goes up. It's been on a little bit of a downturn lately, but I love this company. And then, of course, I'm going to own the indices. I'm not doing anything super exciting in the IRA because, frankly, if you're making deposits, you don't need to do anything fancy with your IRA. Just make your deposits, buy indices, and by the time you're ready to access this when you're 60, it's already going to be $1 million anyway. So you don't really need to worry about it. All right, I've got Ford. I actually bought a couple of years ago to make a quick position. I just wanted to flip it in and out, let it go up 50 cents. This was like 2019 I bought these. Will it show me? I think it will. Give me a sec. All right, Ford, let me see. I want it to give me the tax lot. Yeah, so I acquired shares. Oh, did I buy them in fit? All right, I must have bought these just before the huge crash. I wanted it to just flip really quickly, and then it didn't. It went down. It was the crash. So I just forgot to sell these. But I forgot I had them in my portfolio, and I'm just going to keep them now. I might as well. These ones I've been buying for a long time. TQQQ is probably where I'm going to start putting more money in. Oh, Dustin made it. Hey, thank you, Dustin. I'm probably going to start putting money into TQQQ because I think tech is going to continue to dominate. It's going to keep rising. I might as well go ahead and take the triple leverage position. If it crashes, now I'm screwed. But I like TQQQ too. I'm already up 40% on it. It's the same as I'm up on O, but I bought this much later. I bought this in August versus, yeah. You know, look how long I've been holding QQQ, and I'm making the same percentage gain on TQQQ with less time. So I'm down with it. All right, and then let me get my privacy back real quick, and then I will give you guys my actual non-taxable portfolio, or my tax. Where am I at here? What happened? All right, privacy please, and then I will, once I'm back to life, I will open up my proper portfolio. Should have made that really small. All right. All right. Now here, what am I missing? There we go. Okay. So we've got here, is the last thing we'll do. Apple, I actually own I own more Apple than I thought I did. I have not 400, but 562. I don't know where the hell all those came from. When did I buy more Apple? Anyway, I've got 562 Apple, not 400. All right, it's going to be one of my long-term holds. I'm probably never going to sell this thing. It just keeps rising. I'm getting dividend. It's really nice. Yeah, it's been over 5 minutes. All right, 2 minutes. I'm about to finish up. I'm coming up. I gotta leave. Okay, I've got Leaps on Apple. Intel, I'm just speculating that it's going to get its shit together in the next year. So we're going up. I bought some calls, just holding Leaps. Expire in 2022. ET and KO for the dividends. Lam Research, I'm obviously down pretty big right now on the on the covered call that I sold at 420. I'm continuing to roll this thing, and I'm selling short puts, and I'm buying leaps in order to make up for it. So I've done the short puts several times. I keep rolling these things. Probably made a couple thousand off of them, and I'm up to another 600 now. So I'm just going to keep buying some shares with it. I've got 103. Eventually, I will get out of this roll, and if not, I'm just going to buy them back. All right, Lamb Research, I'm all about. Love this company. All right, Altria, just covered calling on Altria. NLY. Nokia is a pretty shitty position, but I think they're going to get it together, so I own a couple of leaps. Palantir right now, I'm happy with the way this one's going. Even though I'm down on the covered call, I'm up tremendously on the leaps. This is a poor man's covered call. If I take this one off the table right now, I'm going to get my collateral back, and I have enough money to buy 100 shares right there off the top with just the gain. Make 100 free shares of Palantir. All right, Prudential, I'm holding for the dividend. Triple Q, I'm just going to keep rolling with Triple Q. I've got the leaps. I've got the short put. I've got a strangle open on Triple Q right now. This I'm probably just going to end up buying back. It's a deep into money covered call. Who's going to murk me? Miss Millions? Yeah, I'm about to get killed. All right, so I'm leaving. All right, SMH I'm holding. Space I'm doing. You guys can see what I got going on in Space. I got it going. SPHD is my dumping ground for dividend. And I've got leaps on SPY, doing very well, almost doubled up on those. So total account value, we've got 457,000 here. Tesla, I'm trading right now. I love Tesla. I'm just selling out of the money puts and making tons of money here. So very happy with the way this is all going. And T, of course, I'm just holding for the dividend. This one's 450,000, and then my IRA is another 61, and I've got Webull, which is about 30. So it's going well. I just keep investing, and that's the way it needs to go. So leaps are probably the best strategy right now. Poor man's covered calls second best, and then selling covered calls. It's not the best environment for that because things just keep going up. So, all right, wrapping that up. Thank you everybody for participating in this stream. I really appreciate it. I think it's the longest one we've done, and thanks for sticking it out with me while we went through all the technical difficulties in the beginning. So appreciate it. Thanks everybody. Have a good day, everyone.